It's Sunday, May 7th, and it's time for another episode of Mayhem in the Markets, brought to you by Macrovisor, where we make macro easier and actionable. Isn't this something? 15 stocks have made up for 97% of the gains year to date in the S&P 500. This is to some degree unprecedented. I think the narrowness of this breadth, and it's about 7 stocks that make up 90%, just to give you an idea of how concentrated this is. This is why we see a lot of portfolios that are still down year to date. If they're not in these index funds, if they're just in stocks that haven't participated as much in this narrow rally. Now, narrow breadth is often something that precedes a leg down. It doesn't always, but it is a bit of a warning sign because it also means that the market is more vulnerable. That is to say, if these market leaders, these very large stocks, and these aren't just 15 of any stocks, these are the 15 largest stocks in the index. If these leaders start to stumble, that is likely to be a pretty big deal for this market that continues to see resistance around 4,200 on the index. That's the key level that I'm watching. I think if we break above that, we've got some room higher. But if we can't break above that, eventually we're probably going to start to retest that lower end of the range. And remember, there's an enormous wall of puts at 4,000 SPX. So we could kind of bump around that range. If we break below there, I think we could get right back to 3,800. If we break above 4,200, I think there's no reason we can't go to 4,300. But I'd be surprised if we get much further than that. I still think the path of least resistance, particularly as we get to the second half of this year, is likely to be lower. And look at the weight of just Apple and Microsoft in the S&P 500, each accounting for 7% of the index's weighting. Combine them, and that's 14%. That's 2 stocks out of 500 that make up 14% of the index weight. Is it time to reconsider the idea of market cap weighted indexes for passive investing? I personally think it is. I'm more leaning towards looking at equal weight when I feel like there's an opportunity when we've gotten to an economic trough, an earnings trough, and a market trough. I think at that point, equal weighted value factor are going to be more attractive. I also think there'll be opportunities outside of the US, but I think it's early yet to say that the worst is behind us. But what really concerns me about this chart is just another example of that extreme concentration. And we can see it here too. US tech versus the S&P 500 is back to a ratio we really haven't seen since just before the dot-com bubble busted. This is extreme. And it concerns me because seeing something like this is showing you how precarious this market is. There's simply too much concentration in large technology companies. Now, it's not the same as the dot-com bubble in the sense that, these valuations are a little bit more rational, but they're still expensive. And I don't think that it makes sense for tech to have this level of leadership in a late cycle environment with rising real rates, where earnings have peaked and are on the decline. And many companies are showing signs that they're not likely to recover for some time to come. Even Satya Nadella of Microsoft, who's probably the best CEO in all of big tech, has said he's prepared for years ahead, 2 or 3 years of pain before they really get out of this environment. And Microsoft's the best performing tech in terms of their earnings. They're actually continuing to grow. So they stand in contrast to Google and to what we've seen at Amazon and Tesla and some of these other technology companies. I think that if Microsoft is saying that, the rest should pay attention because their products are stickier. It's harder to extricate your business from Microsoft 365 or Azure than it is from, say, Google ads or Meta ads. So I'm looking at this and saying, gee, maybe we're going to see something that we've seen during prior cycles after this sort of what you could call an anomaly, which is to say that perhaps tech will not be leading during the next cycle. Maybe it will be more of the old economy stocks, energy, materials, industrials. Once we see a earnings trough and an economic trough, perhaps they start to lead the way because the supply side inelasticity in those same markets continues to be a problem. And once we have demand come back, commensurate with more normalized levels, those same stocks, those old economy stocks, may end up outperforming the broader market. And I think that's something to pay attention to, because as you go throughout history and look at bull markets, their leadership composition tends to change. So do the heavyweights in the index, the largest stocks. That all tends to rotate. Now, I don't have any way to tell the future. Past isn't necessarily prologue, but these are patterns that go back quite a way. So it's something to pay attention to, because everyone is looking at tech as if it's a safe haven, as if it's the best place to go. And you've got these companies trading at valuations that suggest growth, and yet they're not really, most of them at least, are not growing. Mentions of AI are up a staggering 85% year over year on conference calls. This is not great. And here's why. AI has a lot of potential. It will change the way we do business. It will change the way we interface with data. It will change how we search for information and how we utilize information. It will also augment and increase our productivity. And there are some signs that we're improving our technology in that area. But we don't yet understand the human brain. In fact, I would say too little effort has gone into understanding the human brain. We don't understand consciousness. We don't understand how we communicate, how we articulate our thoughts. And that's actually a very intensive process for our brain. It uses a lot of energy and brain power to communicate. So it begs the question, if a lot of this AI is algorithmically driven black boxes fed inordinate amounts of data, public data for the most part, it's not really about proprietary data. It's about scraping the entire internet, which a lot of AI engines are doing now, and overwhelming websites in the process, but that's neither here nor there. The fact is that, like I said, these are often, if not always, black boxes. That is to say, even the people that make these AI engines, these language learning models, don't necessarily understand how they work. They're mostly driven off of patterns. The AIs themselves have no concept of what they are seeing or what they are saying back. And that means that we have the propensity for erroneous output, whether it's incorrect information or straight up what are called hallucinations, where the AI will imagine things, but without an imagination, just with this convoluted process. And look, I am a person who's a great fan of technology. I think it will improve the human condition. It already has in a lot of ways. It's also a double-edged sword, of course. And there's a lot of dystopian sci-fi written about AI. But my thought process on this is very simple. We have the A, right? We have the artificial. We do not have the I yet. We do not have the intelligence. We have not been able to replicate human intelligence in a machine. We have things like ChatGPT. Version 4 is very impressive, but it's still quite limited. And I think we should spend more time understanding how our own brains work so that we can more accurately reproduce them inside a computer if we want true AI. And I don't think we're going to have true AI until we can do that. That's why I feel that we're in a bit of a bubble in AI. The other reason is that there's been such incredible returns, particularly for companies that aren't even really AI companies. Take, for example, C3 AI. This is a company where most of their software is just open source software, wrapped with a little bit of proprietary code and marketed as AI when it's not really. That stock tripled from trough to peak this year, from like $10 to even over $30. Why? Because of the ticker symbol. Did anyone bother to look underneath the surface and realize it isn't really an AI company? No, not really. The excitement got ahead of the fundamentals, of the business model, of logic. So we've come full circle because we're talking about AI, which really lacks the logic and the capacity of the human brain. And then we're talking about humans chasing that same idea and pulling forward future returns into the present with that excitement, that hype, that mania. Speaking of hype, this is the Gartner hype cycle. And as we can see, the peak of inflated AI expectations, I added in, by the way, AI, but it applies nevertheless. We are at or near the peak. And that's something to be aware of because the expectations are well beyond the reality. And eventually we're likely to experience what Gartner calls the trough of disillusionment. Sounds very ominous, right? And it sort of is. But the reality is that we're not yet at the point where this much excitement about AI is warranted. And so I think it's important to just take a step back from the excitement, from the sort of upward price revisions and bonanza in AI stocks and say, wait a minute here. Maybe, just maybe, we're getting a little ahead of ourselves. And eventually, we will climb the slope of enlightenment to the plateau of productivity. And that's where we start to see the capabilities match the expectations. And you can see that slope is a much more gradual build. And we've seen this with technology through time. The cloud, the internet, computers as a whole, pretty much everything has had some degree of, oh, wow, we're going to do something right now that isn't technologically possible for another 5 or 10 years. Look at self-driving cars, for example. We're getting there. But the hype was in full speed in 2015, 2016. We're many years later, and we still don't have full self-driving cars available to anyone. There's a lot of experimental models out there like Waymo, and Tesla's working on their stuff, and there's several others like Mobileye, but we're not there yet. And I think that we need to kind of look at technological innovation through the lens of people get really, really excited before this stuff is ready. This is no exception. The NASDAQ, when we look underneath the surface, is showing more new lows than new highs. 2023 has been less, let's say, violent than what we saw in 2022, which is just, the stocks were just getting gutted there. But I don't think we're out of the bear market. I think it's important to contextualize the gains that we've seen as well. Yes, the NASDAQ has risen more than 20% year to date. And that's an encouraging sign, but the leadership is extremely narrow, which this chart helps to illustrate. The index is up 20%, and yet we're making more new lows than new highs pretty consistently throughout most of the year. The other problem, though, is that narrowness of breadth and that pulling forward of future returns in companies that typically aren't really growing. Google, Amazon, Tesla, there's a lot of challenges for these companies, and I've left others out. Meta, they have challenges. Netflix. Microsoft is really the only one that's doing pretty well, but even their valuation exceeds what is reasonable for their growth with these interest rates. So I don't think we're out of the woods. This type of a chart, the way it looks here, suggests we're still in a bear market. And after the dot-com bust, there were 6 or 7 occasions where the NASDAQ rose over 20%. Those were technical, quote, bull markets, unquote. But after each one of those 20% plus rallies, the market would roll over to new lows. Now, I'm not saying, again, that past is prologue, but I think we should be aware that often is the case, it's not until the Fed has cut and 10 months has passed since that first cut that we've really seen a bottom put in. We also haven't seen a trough of earnings or a trough in this economy, which also tend to precede a bottom in the market. So just be aware of where we are in the cycle. This is likely an end credit cycle environment and a counter trend bear market rally that is likely to catch a lot of people off guard. So I'm not putting this out there to scare anyone or tell you how to position yourself. I'm just sharing my observations in case it's helpful to you. Small cap earnings lead large cap earnings. And you can see it throughout the chart, both up and down. And I think it's really important to take that into consideration because the Russell's earnings are rolling over, and some might say, oh, but the banks. Yes, that's part of it. But also 42% of the Russell doesn't make any money. So it's much more sensitive to an environment of rising rates where a lot of these companies are borrowers. But the other part is this is just looking at the profitable parts of the Russell. So we're really kind of taking that out, right? We're just looking at the aggregate index earnings per share. And they're rolling over. And they're likely to lead the S&P 500 lower too. So please be mindful that the earnings recession that we're seeing is likely only in its earlier stages. And I think it's wise to be concerned about valuations and fundamentals. Because we're not in a period of time where throwing caution to the wind is a wise strategy, in my opinion. And remember, if this is a new bull market, it would be the most expensive new bull market in history. That is to say, if we've actually bottomed, then you may want to be a little bit concerned about what that could mean. Because that would mean it's likely that we're going to have a short and shallow bull market. And in my opinion, that's not what any investor wants. I know that's not what I want. I'm very excited to become optimistic of the market again, but we're just too early for that. When we look like we're troughing, believe me, I'll be one of the first people out there saying I'm excited to buy. Just like in January, on the 4th of 2022, I put out a video on the same YouTube channel saying that I felt the bull market was likely over because the Fed was talking QT, and not just any Fed member, but the perennial Uber dove Kashkari was talking aggressive QT. And that was a very big change of heart for someone who had been so supportive of easy monetary policy for so long. And with that and all the other chatter we had heard in December, it told me this was it. And this is why macro does matter, by the way, because that was macro. When a Fed official is telling you we're taking away the punch bowl that made this, at the time, 12 plus year rally possible, that was a pretty big hint that the worst was yet to come. And we even saw the thinning out of the bull market in 2021, particularly as we got past the first quarter. We saw the small caps eviscerated, then the mid caps eviscerated, and then finally the large caps. And in the beginning of 2022, the mega caps, the generals were shot and they fell too. And I don't think we're through that period of re-rating of risk. So that's why I may come off as bearish, but I'm not a naturally pessimistic person. I am a realist. And I like to look at this stuff through the lens of what does this look like versus prior historic periods? What does this look like on a fundamental and macro basis? What do the technicals look like? And the only thing really relatively kind of sort of bullish are some of the technicals if you look at the biggest stocks. But if you look at things at an index level, we've basically been trapped in a range for the better part of 11 months. That's not particularly bullish. It's not super bearish from a technical standpoint either, but the fundamentals and the macro suggest there may be more pain to come, particularly as the likelihood of a recession rises as we get into the back half of this year. So please be careful out there. That's all I want to say. It's just be careful. Retail, like you, like me, has sold twice as much as what they accumulated during the pandemic over the past 15 months. So we, retail, are sellers. That doesn't mean the bottom is in. I've posted this chart before and people are saying, is this the bottom? Look, this is just what has happened since early 2019. Let's not remember that we are in the largest multi-asset bubble in human history that started in March of 2009 when the Fed really started to get more aggressive on their easing in FASB. the regulator of U.S. banks, suspended mark-to-market and enabled, as a result, mark-to-make-believe. S&P bottomed at, I kid you not, 666. And then the market really, from fits and starts, but it really did begin to rally pretty significantly from there. This was, in essence, not dealing with the quandaries that caused the great financial crisis or the insolvencies within the banking system, but just papering over it with more credit and with denial of what was on the books of these banks. Now we are here 14 plus years later, and I don't think that this chart represents the unwinding of that largesse. I do think that we're not in as vulnerable of a position as we were before the great financial crisis, because even though banks are in trouble, and we'll talk about that soon, the amount of trouble they're in isn't quite the same as what we saw leading up to the great financial crisis. There is less leverage on their books. The assets they're carrying are overall of higher quality. What's killing them is that they had dealt with really such a long period of financial repression, of extremely low rates, that they had to go far out on the duration curve and way up on risk to be able to capture a spread. They borrow on the short end, whether it's from depositors or other markets, and they lend into the long end. And so a lot of their assets in loan book are longer duration. And even that longer duration risk was priced very low during that period of financial repression that we're now on the other side of. Now we're in the wake-up call period after the most aggressive Fed hiking cycle we've ever seen. And that's just looking at rates. Throw QT in the mix as well. Up to $95 billion a month of securities rolling off the balance sheet of the Fed, $60 billion of which are treasuries. I don't think that the selling is quite over. And we can see that there is a significant positive correlation between assets of major central banks and the S&P 500. So what does that tell us? Well, as the Fed and the ECB continue down their path of quantitative tightening, and maybe at some point the BOJ joins them, I'm not going to hold my breath for that, but that tells us that the path of least resistance for risk assets is likely to be lower. And I think that is another area that should prompt some scrutiny, because the other side of it is, let's say we're bullish, what kind of forward returns do we expect in this environment? Most of the time from May through October, when leading economic indicators are going negative, which they have for the past 12 months and likely to continue doing so, you have negative returns. A lot of big market bottoms are put in October as well. So I'm not saying that's the trajectory we're going to follow, but I do think it's important to look throughout history and realize we're entering into the weakest part of the year based on seasonal trends. That's why they say sell and may go away. Does it happen in 2023? We'll just have to see. But I do think that the risks are on the rise because, and I think the debt ceiling will be resolved. There'll be more theater. There'll be more nonsense because that's what they do. They'll probably shut down the government again, which will hurt the economy. But I don't think we're going to default. But what happens when they resolve the debt ceiling is about $1.2 trillion of issuance is going to come online, and that is going to add to quantitative tightening. So is the amount of selling by banks. Banks are selling some of this duration, some of their treasury exposure. So there's sort of three forms of distribution happening. The Fed's letting these roll off the balance sheet. The treasury is selling more debt, and banks are selling some of this treasury debt to shore up capital. We do have corporate buyers. We do have investors that are buying. But I don't know if it's enough to offset the magnitude of supply, which means it's likely that rates go higher, risk premiums shrink even more, and risk assets like equities may fall. Speaking of spending money, Apple does buy a lot of treasuries, but they buy a whole lot more of their stock. They've bought over $500 billion of their stock over the last 10 years. Now, what does that do? Well, for one, it actually compresses multiples because if there's less float available, then your earnings per share go higher. Then your PE goes lower. So take that into consideration when looking at valuations. Just how much have they been buying back? And how big of an impact does that have on their valuation? Things aren't always as they seem. Large banks' exposure to commercial real estate is quite high. In fact, when we look at regional banks, they own a pretty big chunk of this commercial real estate. Western Alliance was in the news recently. There was a rumor floated by the Financial Times that they were looking to potentially sell themselves. The stock crashed about 60% on that rumor, rallied significantly on Friday as people were willing to look past that. The CEO of the company said there was no merit to the rumor, but we know how these things go. They sort of ebb and flow. And I don't think we're past the point of seeing the worst in these regional banks. And I do think commercial real estate will be a very big deal as we go throughout this year and the next couple of years, as we're reaching a big maturity wall for this commercial real estate debt. And that's likely to cause some pretty big problems. I think that these banks will be under more stress, but I think some of these commercial real estate property owners will be too, particularly in the areas of office space, where office space utilization is at the lowest levels ever. There's really no normalization post-COVID. People are ostensibly going back to work, but not the way they used to. There's more remote work, there's more hybrid work, and companies also just leased too much space. They were too aggressive with their growth plans. We saw it in some of the biggest companies in the world, but it goes down. It goes down the tier of smaller and smaller companies as well. And a lot of leases are not likely to be renewed. So this issue is not going away anytime soon. I think it will be with us for years to come, and it will be another reason that credit conditions continue to tighten, because these banks may have piles of not so great debt on their books. And it is getting tight out there. This is the result of some of these bank failures. It's a result of Federal Reserve policy getting tighter. It's a result of them looking at their loan books and saying, gee, we need to let some more of this stuff mature rather than issuing new loans. And when credit conditions get this tight, we almost always have a recession. We are in a debt-driven economy. I know some have tried to say that we're in an economy driven by rising wages. That's not true. For one, real wages have barely risen. Inflation has eaten up most of people's purchasing power, which is why 2/3 of consumers are living paycheck to paycheck. 40% are behind on their bills. They have over $1 trillion of revolving debt on credit cards, and the cost of carrying that debt continues to rise. Rising wages in nominal terms are not enough to carry this economy. It may dull the blow, but it doesn't mean we're going to have an expansion built on that alone. This is an economy that needs debt to grow. The government spend, whether at the local, state, and federal level, requires debt to grow, building infrastructure, expanding military, because, we can never stop doing that, and continuing to pay out programs like Social Security, Medicaid, Medicare. That's one of the larger expense items. All this stuff adds up, but so does corporate spend. And if you look at small and medium-sized businesses, they're really at the whims of prevailing interest rates because they have revolving lines of credit. So if they're lucky enough to have credit at all, it's getting progressively more expensive. And the same is true of many consumers. If they have a home equity line of credit, if they're running credit cards, you can get fixed rate debt on a mortgage or an auto loan. But in other places, consumers are struggling with rising rates as well, particularly with that staggering over $1 trillion worth of credit card debt that has accumulated as a result of rising prices, really causing the cost of living to surge, and wages have not risen commensurate with that. So I take issue with the idea that wages are responsible for the economy staying resilient. I think it's helped to blunt the blow, but it's really the consumer's capacity to continue trying to borrow. And we're going to see that become diminished as credit becomes more tight. The other issue is with small and medium-sized businesses as the larger borrowers out there at these variable rates, they're likely to see their credit constrained, and where they're lucky enough to get credit, it'll be more expensive. Small businesses are the largest creators of new jobs, followed by medium-sized businesses. So they're likely to turn that in reverse in a pretty big way And I do think non-farm payrolls on Friday are overstating jobs. You can see that the data from the prior month was revised meaningfully lower. So we probably want to look at some of this employment data with a little bit of skepticism, because I think it's just a little bit optimistic versus what the reality is on the ground. Michael Hartnett of Bank of America says that the Fed broke the regional banks, adding to this chart 2023 U.S. regional banks as the crisis that the Fed created by raising rates as aggressively as they have. And I think he's right in the sense that they did help to break the regional banks, but I don't think that's the only type of crisis we're going to see, both in terms of region and industry. I just think it's the first. But I think European banks, like we already saw with Credit Suisse, there'll be more issues over there. I also think there'll be more issues in other debt-dependent industries, and particularly, I think we will see a pretty big surge of unemployment as we get to the back half of this year, as we see these tightening credit conditions have a more prolific impact on businesses. And here's a chart from Michael Bostek. I may have mispronounced his last name. If so, I apologize, but it's a great chart. It's not adjusted for inflation, although he does have another that is. But I wanted to share this because it went pretty viral on Twitter. And the big takeaway is, look at how many banks failed during the great financial crisis. It was rather incredible, wasn't it? So many small banks. And yet we are extremely overbanked now. We've seen 3 large banks fail. This is likely, as sad as it is to say, only the beginning. I think we have more to go. Over 50% of America's banks could be considered insolvent because their liabilities exceed their assets. So with more stress, with more rumors, with more runs, this situation could get worse. And last week we saw episodic bear raids of these regional banks driven by short selling and put buying, really pressuring those shares lower. And then Friday, of course, we had that relief rally. I believe PacWest was up about 80% on the day. That's a classic bear market short squeeze rally. And it doesn't necessarily mean the worst is behind that bank. And I think this chart is going to get a lot more populated for this year as time goes on. And again, I don't want to see that happen, but it is something that concerns me, and all signs point to that. And unrealized losses are at high levels. As interest rates rose during 2022, the market value of bank securities significantly declined, creating these unrealized losses, which are anywhere between 650 billion and 2.1 trillion, depending on the amount of banks that you're including in that, whether it's the FDIC reading or just the total system based on estimates that have been used for some of these academic research papers. This particular slide comes from the Federal Reserve itself. This was released actually in February, and it gives us some sense as to why Powell was so nervous at that meeting in February. He knew this was happening and what was coming, and I think he was a little bit concerned about the impact of monetary policy on this part of the banking system. In fact, they even mentioned some concerns about regional banks and commercial real estate in the minutes. And social media as a bank-run catalyst. Social media fueled a bank run on Silicon Valley Bank, and the effects were felt broadly in the U.S. banking industry, including in First Republic. And I know that some people don't believe that social media has much of an impact on banks, but it does. And the reason is that information, including fear and FUD, travel at the speed of light. Now, I just mentioned about half of America's banks have more liabilities than assets. So you could create a bank run at a lot of different banks. It's not just the bank that's the problem. It's a systemic issue. And when there's someone screaming fire in a crowded theater, there's going to be trampling and there's going to be collateral damage. So yes, the banks that have failed had issues, but there's a lot of banks that have significant issues that could also fail. And all it takes is someone saying this bank is insolvent, screaming it from the hilltops with a loud enough voice, with a big enough account. And if that catches on, and if you see a significant run, it could kill a bank. And I'm not talking about a giant money center bank like a JP Morgan, but these small, mid-sized, and large regional banks are much more vulnerable, particularly because American consumers are much less trusting of financial institutions than they were earlier during this period. Like if you go to late last year, You look at some of these surveys, people are not as worried about banks as they are now. Now, there's a lot of distrust, and people are concerned about amounts they have that are beyond their insured limits, which I think is wise. I don't think people should be keeping more than $250,000 in any single bank account. And, if you're like me, you're looking at putting money in short-dated treasury bills because that's where there's been great returns, and there's even some tax preferential treatment in the yields for people in the U.S. So, obviously talk to one's financial advisor, figure out what works for you, but there's no reason to concentrate our positioning in the market in any one stock any more than there's any reason to concentrate cash above 250K in any one bank. And the New York Fed probability of a recession in the next 12 months is at 57.77%. That's the highest reading in 40 years. So I think it warrants some concern. This has been a pretty reliable indicator. When it hits this level, it cannot be ignored. And the chance of a recession happening, I think, is extremely high in the back half of this year. And looking at money supply, I know there's been a lot of folks out there talking about this, and I have as well. We've seen money supply fall for the first time year over year since the Great Depression. But going into this, we also saw one of the largest builds of money supply that we've ever seen. So we may just be returning to trend in terms of the trajectory of money supply growth, but as money supply shrinks and goes negative, it does make it more difficult for people to pay back debt and for banks to lend. And in a debt-driven economy, that's going to cause some turbulence. The idea of a soft landing seems far-fetched. And Fed funds now are higher than inflation, which is a good sign. It means that in all likelihood, we will see some more demand destruction, a slowing economy. We saw 1.1% GDP in the first quarter, part of that because inventories were not being rebuilt, which, by the way, the reason for that is that they were so aggressively built in the fourth quarter of last year. Nevertheless, this is what economists have been calling for Fed funds to go higher than inflation. Inflation's trending lower outside of core services, and Fed funds are trending higher. Maybe the Fed has paused. At the very least, they're likely to slow their roll of rate hikes as they see the lagged and variable impacts of that monetary policy on the economy. And remember, they only started hiking in March of 2022, and the first round of QT started in June of 2022. So with those lagged and variable impacts, we still haven't seen the full effects on the U.S. economy. So I want to thank everyone for tuning in. Really appreciate your support. If you enjoy my content, consider liking, subscribing, and sharing this video with your friends. Also, check out macrovisor.com, where we make macro easier and actionable for everyone. That's for people that are really interested in the longer term horizon, the swing trades, the investments, the more deep dives into the economy and what's going on in the themes that may arise. Also, check out TraderAid. If you're a shorter time horizon trader, if you're more interested in technicals, that's another project that I work on with my partners, and we have a lot of fun there. We create a lot of great content, educational material, actionable resources there. You can get a 20% discount using the code Mayhem20. So you, in fact, get 20% off on me. Again, that's Mayhem20. And check me out on Twitter. You can follow me at Mayhem4Markets. That's Mayhem4Markets. And I will look forward to catching you all next time. I hope you have a great trading week ahead, and I'm wishing you all the best.